All right. Good morning, everybody. Good morning, all you magnificent melon heads of the world. Happy Friday, everybody. Boy, that week went fast, didn't it? Today is July 25th, 2025. And the top story this morning is Intel's earnings, or should I say lack thereof, and the subsequent layoffs. Getting Groundhog Day vibes here, guys. Intel announcing mass layoffs. Haven't we seen this like a half a dozen times in the last 2 years? And every time I see these articles about Intel announcing layoffs of thousands, I feel like it's a headline like, oh, there's just an old story, somebody rehashed. No, this is new. This is like legitimate. This is actually happening. It's not the same thing we heard last month and the month before that and the month before that. It just sounds a lot alike. Intel reported a loss of $2.9 billion. That is up from a $1.6 billion loss a year ago. That is their sixth consecutive quarterly loss. The whole point of this is to make money, right? I'm just throwing it out there. And I realize companies burning through billions of dollars, you know, if you're named CoreWeave or OpenAI, shit, you get like a $40 billion valuation out of that. You know, hey, why not? Yeah, that's a straight shooter going right to the top there. But apparently with Intel, people are like, oh, no, you're supposed to make money. Well, let's apply that litmus test elsewhere, perhaps. But I digress. Intel also announcing layoffs. 15% of their workforce is getting cut. No, that's not the same 15% they cut last year. This is an additional 15%. Some 25,000 jobs going away. Those layoffs have already begun. They're also canceling tens of billions of dollars worth of investment plans in European plants. And the CEO, Lip Bhutan, said yesterday on the earnings call, there are no more blank checks. And you could hear the analyst gasping when he said that. There are no more blank checks. That is a not even remotely subtle dig at his predecessor, Pat Gelsinger, who was notorious for burning cash in all kinds of investments. Things not good over at Intel. They're tightening belts. All investment dollars are going to be scrutinized. The market didn't like it. Intel shares are getting clobbered. Now, look, guys, we've seen a lot of headlines about tech layoffs recently. And I got some feedback in the comments yesterday because we were talking about the initial jobless claims that came out every Thursday, and people were highly critical of that data point. Look, the data is the data. We just report what the data is here. And I can understand why a lot of people think that, because it seems like the chorus of big tech layoffs is getting louder and louder, in particular Microsoft laying people off. By the way, there was this article in CNBC today, dreadful article about how Satya Nadella is being, he's deeply moved and he weighs heavily all these layoffs on him. The phrase H-1B visa does not appear a single time in that CNBC article. A little disingenuous, CNBC, by the way. But look, these layoffs, they're not hitting the jobless numbers yet. Jobless claims don't show up until people have actually been laid off and any severance that they received goes away. Then they're eligible for jobless benefits. So it is possible that all these headlines of tech layoffs and the low initial jobless claims numbers can coexist. And it would also suggest that in subsequent months, we should be seeing those initial jobless claims numbers start to tick up because of those layoffs. All right. I went back and I looked. I got that challenge. I went and looked in the data. I looked at the MacroEdge job cuts tracker. I looked at the Challenger job cuts tracker. There was a big surge in layoffs at the beginning of the year, but that surge ran its course. And now the job cuts, believe it or not, they are comparable to where they were a year ago. But I suspect that's going to change. Also going on yesterday, we had the Trump-Powell tour of the Federal Reserve Building. That was just some hilarious, backwards, stupid political pageantry. But man, the memes were freaking hilarious. So we'll talk a little bit about that today. Look, I said my piece about what's going on with Trump and the Fed. I don't think Trump is going to fix anything at the Fed. I think he's going to make it worse. You want to criticize the Fed, that's fine, but that's no excuse to make things worse over there. Also, a story that I think pretty much everybody missed. Everybody except my buddy Nashville Pasta Man, who's probably watching right now. Pasta Man, thank you for sending me that. Eagle Bank Corp. That's a name we have never mentioned on this channel. It's a small to medium bank. They got about $9 billion in deposits over at Eagle Bank Corp. They reported a very big, surprising loss yesterday. and their shares dropped about 20% in one trading day off of big losses in office loans. Remember that commercial real estate bubble? Remember that whole thing about how nobody needs office buildings anymore and they're not worth anything and nobody is carrying these things on their books for what they're really worth? And I've been talking about this giant game of the floor is price discovery, and oh no, we can't find out what things are actually worth because then we need to admit all the money we're losing. Well, Eagle Bancorp got a little taste of that yesterday and it sucked. 20% of those shares disappeared. And also there was one little line of text in their earnings release that really jumped out at me. Maybe something we need to keep an eye on there. Wait for that story. That's interesting. Once again, thank you to the Pasta Man for sending me that one. I had some fun with that one last night. We also got earnings from Volkswagen and Phillips 66 this morning. We got Bitcoin got absolutely clobbered last night. It ticked below 116,000 briefly. We're right around that level now. Look, guys, that was a massive deleveraging. Ever since the crypto week and the Genius Act passed, we have seen a surge in leverage build up in crypto, in Bitcoin, but also in altcoins. Ethereum in particular has had a pretty good run. People are getting in and saying it's altcoin season, it's shitcoin season. Everybody's borrowing money to buy crypto. And what did we say on this channel? We warn almost on a daily basis. I say, be careful on leverage. Bitcoin can drop quickly. Well, $500 million worth of longs got auto liquidated last night when the price dropped abruptly. Gee, I wonder if maybe there might be a lesson hiding in there someplace about other places in the market where leverage might be building up. Let's take a look at that, shall we, as well? We've got a couple of headlines in private credit this morning we're going to take a look at. See if you can notice a pattern in those headlines. Oh, man, what a wretched hive of scum and villainy the private credit industry is and what they are trying to do, folks. Do not let your guy put you into that garbage. I'm telling you, those phone calls are coming just as soon as POTUS signs his executive order allowing it. We have not war has broken out between Thailand and Cambodia. They're shooting at each other and killing each other, but it's not a war. No, it's an armed conflict or border skirmish involving heavy weaponry. Sounds war-y to me, but hey, we're not calling it a war, so I guess it's not a war. And last but not least, we had durable goods came out this morning. Lots of volatility in durable goods, down 9% versus a month ago. Almost certainly tariffs are playing a role there, and aircraft, a big chunk of that decline. We'll take a look at those charts. But first, we got to shrink my big melon of a head, and let's see what's going on in the markets this morning. And by the way, guys, don't forget that like button and that subscribe button because we do this every day. So if you're new, come on back tomorrow and have your coffee with the melon heads as we go through markets. And right now, the S&P 500 is clinging to positive territory, about 7 points to the upside, 0.11%. In absence of catastrophe, number go up. The Dow, meanwhile, higher by 69 points, 0.15% higher this morning. And the NASDAQ is modestly negative, an entire 1 point. Oh, there we go. There, now it's green. 1 point to the upside, nothing percent. Not a lot of movement in tech stocks this morning. Intel notwithstanding, that is. The U.S. dollar is a little bit stronger here, 33 basis points to the upside, 97.84 for the Dixie. Looking over at the bond market, we got a mixed bag in yields this morning. The 30-year Treasury, 4.964%. That is higher by 1.5 basis points. The 10-year is at 4.419. That's higher by a point and change. The 2-year is at 3.915. That is down 1 point. And the 1-month Treasury is actually up 2.5 basis points at 4.321. Maybe a little bit of concerns about no rate cuts creeping into the 1-month T-bills there. Keep an eye on that one. Looking over at commodities, we got some red this morning. Metals have had a rough couple of days, but still hanging in there. $3,338 for spot gold. That's off by another $30 this morning, or 0.88% lower. Spot silver back under $39 at $38.79. That's off by about 27 cents this morning, or 0.68% lower. But you know what? As it turns out, I like the shiny. Copper, meanwhile, down 0.4%. Platinum is lower by 1.5%, and palladium is lower by 0.85%. So all the metals are in the red this morning. Crude oil, though, higher by 0.5%, $66.34 for September WTI futures. Check out Bitcoin this morning, $116,105, off by more than $2,200, almost $2,300 lower than this point yesterday. and we hit a low overnight. We actually went below 115. Wow, we went to $114,750 yesterday, and already it's recovering. Guys, somebody went stop loss hunting yesterday, and they found it. Margin calls went out. You got to be careful on leverage when you're dealing with volatile assets like crypto. Take this one in Cointelegraph. Bitcoin tumbles below 116,000 in bloodbath for crypto longs. The sudden crypto market downturn saw 213,729 traders get liquidated for a total of nearly $600 million over the past 24 hours. And I know among those 213,729 traders, there were no melon heads, because we don't do that here, right? We don't go out on leverage and buy crypto. It's not what we do here. Careful. It's too freaking volatile. More than $500 million in long positions were liquidated across the crypto market on Friday as the price of Bitcoin slipped below $116,000 amid a broader market tumble. According to CoinGlass data, $585.86 million in long positions were liquidated, with Bitcoin accounting for about $140 million of the total, as it dropped 2.63% to 115,000. It actually went lower than that. So most of the liquidations were not in Bitcoin. It's the altcoins that really got crushed. Dump is pure leverage flush, says trader. Ether, following a 104.7 million in long liquidations, falling 1.3% to 35.98 over the same period. Dogecoin led the losses among the top 10 cryptocurrencies by market cap, dropping 7% over the past 24 hours to 22 cents. And wiping out 26 million in long positions. Crypto trader Ash Crypto said in an X post on Thursday, "This dump is a pure leverage flush," he explained. "Many people longed alts after they saw ETH pumping hard, so market makers dumped and liquidated the longs." This is why I say over and over, guys, be careful when you go out on leverage, and keep in mind, crypto winter is coming. In my opinion, sometime between now and October, we will get the big one that takes us down for a couple of years. Now, speaking of being careful with leverage, in totally unrelated news, check out this chart. Shout out to my moderator, Mish, who found this one. This is from Augur Infinity on Twitter. Thank you, Augur Infinity, for posting this one. U.S. margin debt exceeded $1 trillion for the first time in history in June. Gee, I wonder, why do stocks keep going up? Why no matter what happens in the economy, do stocks just keep going up? Do you think maybe that might have something to do with you freaking maniacs borrowing $1 trillion and using it to buy stocks? You think maybe that might be pushing valuations a little to the upside? You think maybe you guys might be running a little wild with this? Maybe overheating a little? No? Okay. Hey, you know what? I just throw it out there. You guys do what you want with it. $1 trillion in margin debt. What's the worst thing that could happen? After all, we never deleverage, right? The fact that we borrowed $1 trillion, and that means at some point we have to sell stocks and pay back $1 trillion. Nah, you know what? Just FOMO in the AI stocks, and don't let little things like $1 trillion in borrowed money inflating a stock bubble worry anybody. What's the worst thing that could happen? Don't answer that. All right, check this one out. Yeah, this is President Trump giving Jerome Powell his Christmas bonus yesterday. It's a 1-year membership to the Jelly of the Month Club. This was Jerome and Jay Powell yesterday. What a stupid exercise this was. The whole point of this media circus was just so President Trump could make a couple of digs at Jerome Powell. And you guys know, look, I take cheap shots at Jay Powell all the time. He deserves it. He printed $6 trillion and ruined people's lives through inflation. All right. But you know what, Mr. Orange, you played a role in that too, because you were right there telling him to do it during your last term. And now you want him to turn the money printer back on, and he doesn't want to do it. And so you're making a big stink about these renovations. And it's stupid, guys. They're getting ready for the next print. And by the way, Andrew Ross Sorkin and all these other people like Steve Leisman, everybody, all the people who are going to be at the next FOMC meeting, and they're going to be like, "Oh, my Fed independence. And what do you want to say something mean about President Trump? Here's your opportunity." They all secretly yearn for this. They want those rate cuts. They want those money printers to come back on. They want that inflation to come back because it makes them and their sponsors filthy freaking rich. So while the financial press pretends to be all like, "Oh my God, I'm so offended by the threat to the Fed independence," There is no such thing as Fed independence. The Federal Reserve exists to help the rich get richer at the expense of the poor. They excel at that. And that is why this is all just a stupid circus. They're going to lower and they're going to print anyway. Meanwhile, Rick Scott's over here like, hey, guys, how come I don't get a hard hat? And President Trump says, shut up, Tim. You're never going to be president. You just don't have the hair for it. Maybe OSHA want to weigh in on this? I don't know. You kind of walked right into that one, Donald and Jerome, didn't you? What is it about Rick Scott's head? I don't know, but I digress. All right, let's move on from that stupid story, shall we? Intel to lay off 15% of workers and cancel billions in projects in a bid for rebound. The American chip-making giant faces strategic crossroads as it chases rivals like NVIDIA and Taiwan Semi in the global silicon boom. Intel will cut 15% of its workforce and scrap plans to spend tens of billions of dollars on new chip facilities in Europe as it takes steps to revive sagging fortunes. The chip-making giant said Thursday it would refocus its strategy on highly competitive market for AI chips, regaining market share in personal computer processors, and developing its advanced 14A technology to sell to large customers. Intel, which has long dominated the business of making chips for laptops and desktop computers, fell far behind competitors such as NVIDIA, whose CEO is shown below here, filleting Chinese Communist Party members, along with Advanced Micro Devices and Taiwan Semiconductor Manufacturing Company, after it failed to anticipate the surge in demand for the powerful chips fueling the artificial intelligence boom. There are no more blank checks. Intel Chief Executive Lip-Bu Tan wrote in a memo to staff, every investment must make economic sense. Most of the layoffs, which began in the first few weeks of the current quarter, targeted middle management, the company said. Intel is targeting a total headcount of 75,000 by the end of the year. That would suggest about 25,000 more layoffs are coming. Intel's loss for the second quarter widened to $2.9 billion from $1.6 billion loss in the year earlier period. The results represent the company's sixth consecutive quarterly loss, extending its longest streak in 35 years. Things at Intel are not going well. That stock getting clobbered this morning, down 8% in pre-market trading, $20.81. Year to date, though, the stock is actually up 12.8%. So yeah, I guess they could stand to lose it a little bit, but Intel has totally sat out the AI bubble. All right, now let's talk about this one, guys. We never talked about this name before. Eagle Bancorp. It's never come up in my research. It's not a big bank, about $9 billion in deposits. They had a market cap of about $600 billion. That was until yesterday when they lost 21.2% after reporting earnings. A big drop for Eagle Bancorp. So what happened to this one yesterday? Well, we got this in investing.com. Eagle Bancorp reports a $69.8 million net loss in the second quarter amid office loan issues. That commercial real estate bubble has not gone away. Eagle Bancorp, the parent company of Eagle Bank with a market cap of $653 million, reported a net loss of $69.8 million or $2.30 a share for the second quarter ended June 30th, compared to a net income of $1.7 million in the first quarter. According to Investing Pro analysis, while the company is currently trading below its fair value, analysts expect a return to profitability this year. Not with office loans like that. That ain't going to happen. Heck no. The significant loss was primarily attributed to a $111.9 million increase in provision expense as the bank took decisive action to address risk in its loan portfolio, particularly in the office real estate holdings. Despite the quarterly loss, the company's pre-provision net revenue increased to $30 million. They're like, oh, yeah, other than the fact that we lost $100 million on bad loans, our net interest margin is looking really good, though. The people who are paying us back a lot of interest. But, yeah, they're losing $100 million on loans. The allowance for credit losses as a percentage of total loans rose to 2.38% at quarter end, up from 1.63% in the prior quarter. Coverage of performing loans increased substantially to 11.5% from 5.78%. Non-performing assets increased $26 million to $228.9 million. Let's see. Net charge-offs for the quarter, $83.9 million, resulting in an annualized quarterly net charge-off rate of 4.2%. That's the big one right there, guys. That $83.9 million. That's where the loss came from in net charge-offs, basically saying, nope. No, these people are not going to pay us back, so we're just taking the hit. That's their $70 million loss right there. But on top of that, non-performing assets continued to go up, which means even though they're taking the charge-offs, saying these people aren't going to pay us back, there's more people in the queue who are not paying them back. So, yeah, this is not good for Eagle Bank. Also, something I noticed, this is in their actual press release. I just want to read you this. Non-performing assets increased by $26 million to $228.9 million as of June 30th. During the quarter, non-performing loan inflows totaled $222.8 million, primarily driven by office and land properties, including a $33.6 million data center loan backed by office collateral. That's the first I've ever heard of data center loans this was non-performing. All right, so they're not paying it back. Somebody out there, I don't know who, borrowed $33.6 million to build a data center. They posted their office as collateral, and this bank took it. I can't imagine why they did that. And now that's a non-performing loan, which means they're not paying. All right, now, this is the first I've heard of anybody in the data center space not covering their debt, but that's something to keep an eye on. I've never heard of that before. By the way, this bank has a lot of uninsured deposits. Total on-balance sheet liquidity, $4.8 billion. That compares with $2.3 billion in uninsured deposits. $2.3 billion in uninsured deposits out of about $9 billion in total. That's a lot of uninsured deposits at this little bank. Uninsured deposits are notoriously flighty when things get bad. So keep your eye on this bank. It's not at risk of failure yet. There isn't a run going on this bank, but I would say this one is possibly ripe for it. A lot of bad loans, a lot of office loans, that questionable data center, keep an eye on that, and a lot of uninsured deposits. So commercial real estate bubble, guys, it has not gone away. It's still out there. The floor is price discovery. And as my buddy Pasta Man said, by the way, Pasta Man, thank you for sending me this story. Is this price discovery? Yup. This is a tiny little morsel of price discovery. And this is what it looks like. Down 20%, 21% in one day. All right, we also got Volkswagen earnings here. We won't spend too much time on this one. They cut their guidance after taking a $1.5 billion hit from U.S. tariffs in the first half. That's pretty much the story here, guys. I mean, earnings dropped about $2.3 billion. $1.5 billion of it was from tariffs. Germany's Volkswagen on Friday lowered its full-year guidance and reported a sharp drop in second quarter profit as the auto giant navigates the disruptive impact of U.S. tariffs and restructuring costs. There was also a hit to their margins from EVs, which are much lower margin than their internal combustion engines. So, look, Volkswagen ADRs down about 0.7% yesterday. They're not trading pre-market here. I suspect they'll be down a little bit on that news as well. Year to date, Volkswagen's had a pretty good year, though, up 23.6%. As far as automakers go, you can do a lot worse than that. Also, we got earnings from Phillips 66. Their profit beats estimates on higher refining margins. Looks like those diesel prices really helping Phillips 66 here. I don't know why I couldn't get Phillips out there. Refiner Phillips 66 beat Wall Street estimates for the second quarter profit on Friday, helped by higher refining margins and lower turnaround expenses. Top U.S. refiners were expected to post higher second quarter profit, rebounding from losses in the prior quarter as stronger than expected diesel margins lifted earnings. The improved margins helped peers such as Valero Energy surpass Wall Street estimates. Fuel makers have seen an unexpected boost in profit from key products in recent months, offering relief as earnings retreated from 2022 highs driven by post-pandemic demand rebound and supply disruptions following Russia's invasion of Ukraine. I don't know. They're referring to the big spike in fuel prices after the Ukraine invasion. I don't know why you'd mention that in 2025, but there it is. Phillips is making a lot of money on diesel. U.S. refiners are selling a lot of diesel in the European markets because, it's not good for the environment to refine diesel in Europe. But if you have it refined outside the environment in another country, well, all of a sudden Greta is placated, and so they'll go ahead and buy it from the United States, which means good margins for Phillips 66, which is trading up 2.25% this morning, pretty much just offsetting the losses from yesterday, $127.05 for Phillips 66. All right, let's talk about this one in Bloomberg this morning. Keep your eye out for this one, guys. I'm telling you, what's going on in private credit is so unbelievably sleazy. It is a very 2020s thing. Private lenders from Blue Owl to Blackstone are ready for 401k win. And if it's a 401k win for Blue Owl and Blackstone, that must mean it's good for you and your 401k, right? Right? no? Well, let's read on, shall we? When word spread last week that President Donald Trump is keen to spur more private assets into retirement funds, the biggest direct lenders were more than prepared. In fact, the industry has been laying the groundwork for quite some time. Firms including KKR, Blackstone, and Blue Owl Capital had already set up partnerships with 401k managers. Trade groups and industry executives have also been lobbying officials in Washington and making their case to the public, all part of a long-running effort to expand exit liquidity. To expand private credit's reach. I'm sorry, Freudian slip there. I don't know what that was. In interviews, executives repeatedly made this point. Why should only the elite have access to this type of investment? It's so benevolent of them, isn't it? A frequent topic of discussion is the potential risk in private credit, you think? Said Curtis Luker, head of direct lending at Marathon Asset Management. But if you look at the returns that can be generated and the low volatility in private credit, especially compared to public equities, where most 401ks are invested, we think the risk-adjusted return is very attractive. Okay, let's dissect this statement from Mr. Lucker, whatever he is. If you look at the returns generated and low volatility, well, first of all, returns. Why are the interest rates so high on these private loans? That's interesting. Could it be maybe because those entities can't get loans anywhere else because the banks aren't allowed to lend to them because it's too risky and therefore they charge a higher interest rate? Maybe that's why the returns are so high. You think maybe that warrants mentioning? And especially compared to the volatility. Oh, the low volatility in private credit. Well, gee, do you think that has something to do with the fact that the price is virtually just controlled by whatever you say it is? Because you never mark this stuff to market. There is no price discovery. So, of course, it's low volatility. You never admit or tell the truth about what this garbage is really worth. That's why it's high return, low volatility, because you're lying, Curtis Luker, you and your whole freaking industry. And that's why they think the risk-adjusted return is very attractive. Well, tell me, Curtis, tell me, Bloomberg, if the risk-adjusted return is so attractive, then why this headline from just yesterday? BlackRock private funds face attempted exit by key investor Arch. While we're scrambling to make it okay for 401ks to invest in this stuff, why are big institutional investors dumping it? That's interesting. A key investor in BlackRock's private funds is looking to cut its stake following disappointing performance and senior executive departures at the U.S. asset manager, according to people familiar with the matter. Wait, what happened to the low volatility and in fact, wonderful risk-adjusted returns? What is this whole disappointing performance and senior executives leaving? Oh, is that a good thing when senior executives abruptly exit? Does that mean bullish? Bermuda-based insurance firm Arch Capital Group, which has holdings in at least 10 BlackRock funds, is in talks to sell at least $350 million of stakes to secondary funds, including Ares Management. Oh, hey, that's one of the funds that we talked about in the last article. One of the people said, asking not to be identified, discussing a private matter. The portfolio includes Arch's $200 million investment in BlackRock's APCO Fund 2, which raised less than half of its $1 billion fund target. Gee, why can't they raise the $1 billion target? Probably because nobody wants to buy this crap. Maybe that's why, we'll just sell it to 401ks instead. Although the APCO Fund 2 has been generating decent returns, again, because of the high interest being charged on these loans, the other three private funds that Arch is seeking to exit from have been below expectations, one of the people said. If Arch proceeds with the plan, it would add to the headwinds recently faced by the world's largest asset manager. Last month, BlackRock and Abu Dhabi state-owned wealth fund Mubadala Investment mutually agreed to unwind their private credit partnership due to difficulty in sourcing deals. Mubadala, maybe you want to Mubadala somewhere else? Get it out of the fund that's it's in with BlackRock? I don't know. But why is this happening? Why is the Abu Dhabi Wealth Fund and why is Arch Capital getting all their money out of these funds while they're simultaneously trying to sell them the 401ks? By the way, this article goes on to list executive after executive that is leaving these funds. Their chief investment officers, their presidents, their CEOs, they're all quitting. Even just this morning, we got this one. Morgan Stanley names new lending fund CEO. Just out this morning. Shout out to my moderator, Mish, who caught this one as well. Morgan Stanley's direct lending fund, MSDL, CEO Jeffrey Levin decided to resign from his position effective immediately. The company's filing with the SEC showed on Fridays. CEOs resigning effective immediately. That's always good for an investment, right? Isn't that how that works? By the way, the Morgan Stanley Direct Lending Fund, they loan directly to private equity firms. So, better hurry up and dump this in some grandma's 401k, right? In a statement, it was revealed that the board of directors has appointed Michael Ossie, the company's president, as Levin's successor. The filing stressed that Levin's departure is not the result of any disagreement with the company. Yeah, it's always for personal reasons. It never has anything to do with fraud or underperformance or anything like that, right? It's always, everything's totally fine here. Furthermore, MSDL announced that it appointed Ashwin Krishnan as chief investment officer and Orit Mizrachi and Jeffrey Day as co-presidents. Okay, so the good news keeps coming. Not only did their CEO abruptly resign, but for whatever reason, they're also naming a new chief investment officer. What happened to the last one? What happened to the other two co-presidents? Okay, a lot of executive shakeup at the Morgan Stanley Direct Lending Fund. You know what? Just disregard that and go ahead, plow your retirements into private credit. Good God, what are they doing here? I mean, they're so utterly transparent in their ruthless corruption. It's amazing, and nobody in the financial press is calling them out for it. Look, Bloomberg, nowhere in these articles does Bloomberg talk about the ridiculous risks associated with this, about how the only reason this industry exists is because the banks aren't allowed to make these loans. Bloomberg doesn't mention that. They're just like, oh, no, democratize finance, increase access. It's a wonderful opportunity. I tell you, man, it defies logic. By the way, Thailand and Cambodia. Yeah, Thailand warns of war with Cambodia as U.S. calls for ceasefire. So the fact that they're warning of war would suggest there isn't currently a war, even though they're calling for a ceasefire. And don't you need a war in order to have a ceasefire? I don't know, but it's very important. As long as we don't call it a war, everything is okay. Thailand's acting leader warned that the armed military conflict with neighboring Cambodia could potentially develop into a war. Don't you just hate when those armed military conflicts turn into wars? As long as the armed conflict doesn't become a war, we'll be okay, as troops use rockets and artillery to shell targets along their contested border for a second day. Acting Prime Minister, something I definitely can't pronounce, told reporters on Friday that the severity of the clashes was escalating, endangering civilian lives, and Thailand was committed to defending its territory and sovereignty. The situation could potentially develop into war. At present, it is still considered an armed clash involving heavy weaponry. The guy said, well, okay, an armed clash involving heavy weaponry. It's a good thing it's a not war. Not war has broken out between Cambodia and Thailand. By the way, Cambodia, that is a Chinese-backed government, and Thailand more friendly with the West. So I don't know, is this like some little proxy skirmish breaking out in Southeast Asia? I couldn't tell you guys. This is a long-standing territory dispute. It's been going on for years. This flared up a couple of years ago as well. But we're in the second day of this fighting, so we'll keep an eye on this one. Last but not least, let's talk about durable goods orders. This data just came out this morning. They were down big, negative 9.3% for durable goods. The important thing to notice here, guys, is look at the volatility in durable goods. You notice the amplitude of these oscillations is getting bigger, and anybody who has ever studied vibrations in pumps or motors, yeah, increasing amplitude of oscillations, not usually a good sign of things to come. But look, we had a big spike in durable goods orders in March. That was people front-running the tariffs. And then, oh, crap, the tariffs are here. We had a big decline in April and then, Liberation Day. But then the taco thing happened, and then we had a big surge in May. But now the August 1st deadline is getting here. Oh, June goes down. Yeah, a lot of volatility here. Now, so big 9.3% drawdown in durable goods. Let's talk about where it came from. When you strip out transportation, all of a sudden durable goods goes positive. So that means this big decline, it was all transportation related. That means cars or aircraft, and it looks like it was almost entirely aircraft because non-defense capital goods orders ex aircraft was only negative 0.7. So when you strip out planes, when you strip out defense, you go from negative 9.3 to negative 0.7. It was Boeing. It was planes. There must have been a big order for planes in May, and then that didn't happen in June, so it was a big decline. Not good, to be honest with you. The durable goods didn't really affect markets at all, so maybe this is just standard volatility associated with a big aircraft order one month and not one the next month. But that chart showing the increasing vibrations, if you will, here, that kind of worries me a little bit. So we will keep an eye on that as the days progress. And I just want to say thank you so much to Uncle Fezster, who says, happy Friday, Jack. Happy Friday to you as well, Unc. I remember when Intel bought FPGA giant Altera, they ended up selling 51% of it at a huge loss. Yeah, Intel's made a couple of bonehead moves. I don't remember when that particular acquisition happened. Lip-Bu-Tan here is in a position where maybe he can keep blaming things on Pat Gelsinger for a little bit longer, right? I mean, you know, when he's saying no more blank checks, right? That is a CYA moment for Lip-Bu-Tan. He's basically saying, nope, it's the last guy's fault. He did such a terrible job, and we're not wasting money like that anymore. But he better turn that ship around. 6 consecutive quarters of losses. Not many companies can sustain that for very long. And by the way, you know, Intel, a big part of all that CHIPS Act funding here in the States, that's one of the companies that we're leaning on to try to develop domestic chip manufacturing, and they're canceling their plans to manufacture in Europe. No mention of any U.S. plans or any of that CHIPS Act funding. So I don't know if that's at risk here or not, but that is worth keeping an eye on. Thank you so much, Uncle Fedster, for supporting the channel, sir. Hey, M&J, thank you for gifting 20 Nobody Special Finance memberships. I appreciate the support of the channel, M&J, as well as everything you do as a mod for the channel as well. Welcome to the Melon Heads, you 20 lucky SOBs. Be sure and say thank you in the chat to M&J for gifting those memberships. Thanks again, M&J. Snowman 1201, you want to build a snowman? Happy Friday, Jack. Happy Friday to you. Stay frosty, my friend. Have we done that? I'm getting deja vu. Have I made that joke already? Whatever. It worked the first time, I'm sure. I'm going to make it again. Why not? We're recycling jokes here today. Thank you so much for supporting the channel, Snowman. I appreciate the good vibes, sir. Steve Woitis says, could private equity be to 401ks as CDO derivatives were to financial institutions in 2007? As you know, the big thing with CDOs and derivatives, that was a collateral issue. Nobody knew what anything was worth because nobody wanted to hold MBS overnight. And so nobody was willing to loan. There was like freezing in the repo markets. Nobody was willing to make loans with MBS as collateral. So I don't know that private credit, that those loans, I don't think, don't quote me on this, but I'm pretty sure they're not being used for collateral in repo markets or anything like that. So I don't think it's as big a deal as the CDOs and the mortgage-backed securities were in 2007. I don't think it's going to be that big of a deal. That being said, it is a big deal that it's a multi-trillion-dollar industry. There is a lot of debt there. A lot of big institutions are exposed to this debt. That debt is not getting paid back because those companies are not cash flowing. And so those institutions are desperately trying to get that crap off their books before before what? That's the big question. But they want to get it off their books. And they are looking at your retirement with a twinkle in their eye when they think of who is going to hold this back. And that's why I keep trying to warn people, guys. They are desperately trying to park this crap into your retirement. It's a bailout, right? If the government lets them do it, because the government will bail out pensions, they will bail out 401ks. That crap will sail right through both houses of Congress, both parties. Nobody will dare vote against that, all right? So if we're allowing the conditions to create that to happen, that means the bailout is happening right now. That's what this is, all right? If we let private credit park their losses in 401ks, that is a taxpayer-funded bailout of private credit. We're not supposed to be doing that anymore, but that's what it is. Thank you, Steve. That's a good question, sir, but I think the collateral is really the deciding factor in that one. Very good question. Thank you. Thanks again for supporting the channel, Steve. Wally, thank you, sir, for supporting the channel. He says, what do you think of the Genius Act? Are stablecoins going to be used as a backdoor CBDC, or do you believe that we have been spared of a CBDC? No, I don't think we've been spared of a CBDC. I think what a CBDC represents, the programmable money and the absolute control over people's behavior that comes along with that, that is just too juicy for those elitist quacks to pass up on. So that requires constant eternal vigilance to make sure the CBDC does not happen. And the Genius Act could be a backdoor to get that. Now, the Genius Act doesn't allow a CBDC. The Genius Act just creates a regulatory framework for stablecoins. But I could see how that could eventually lead to a CBDC, because if JP Morgan has their own stablecoin and Coinbase does, and Binance, oh my God, Binance, if they still have their own stablecoin, and Circle has a stablecoin, there's all of these different stablecoins out there, and they're all supposedly $1, but then they all trade at different levels, and arbitrages between them start happening, and then, one might fail, or the other might pick up the slack, or the companies get bought and sold. I could see a government coming in and saying, you know what, this is messy here, so we're going to simplify things by consolidating all these stable coins into one central bank digital currency. I could see how they could create the situation where a CBDC might get rolled out. So be vigilant for that. Now, that being said, I think stable coins are stupid. When you really think about what a stable coin is and what they're going to do with it, the government wants it because the money is going to flow into the treasury market. And then, while the money is sitting in the treasury market, the stablecoin issuers collect the yield while paying nothing in yield to the people who park their money in stablecoins. So at the end of the day, what is a stablecoin? It's nothing more than a money market that yields nothing, that lets you buy crypto on weekends. That's what a stablecoin is. I'm not a big fan of them. I won't be parking any money in them whatsoever. Thank you, Wally, for supporting the channel, sir. And thank you, everybody, for having your coffee with the Melonheads this morning. Thank you guys so much for all the super chats and supporting the channel. I appreciate the generosity, as well as the generosity of you magnanimous Melonheads on Patreon and YouTube. Don't forget, 2 p.m. Eastern Time today is our weekly get-together on Zoom. I'll be sending that link out in the moments ahead. Looking forward to talking to you guys as we do once a week. Links down below should you feel so inclined. Don't forget that like button and that subscribe button for the algorithm. Hi, Mom. Hi, Dad. Love you guys. Everybody, till next time, live small and dream big.